Hello everyone. We're going to talk a little bit about geopolitical risk and the general macro environment and earnings season. Let's start with geopolitical risk. In Brazil, political turmoil is very evident and obviously has made both the real and the stock market collapse very quickly. However, we need to pay attention to the macro environment. The macro environment is not helping. GDP estimates have had to be downgraded already a few times. Also, the earnings season is not proven to be as positive as in other countries, and capex, consumption continue to be very subdued. So be careful when you trade Brazil, thinking about the exuberance of inflation, because there are many headwinds. In the US, it's quite different. In the US, we have an environment in which political turmoil, which is quite evident, obviously, is not so relevant. First, because it's likely to end in nothing, but more importantly, because the macro and earnings environment is definitely positive. The macro that's showing both at consumption level, capex growth for the first time in many years, also in terms of wages, in terms of employment, all of those different points of data help us understand that the US continues to be an important driver of investment and a place where it's worth buying the dip. It's worth buying the dip as well. Look at the agreement in Saudi Arabia. The agreement in Saudi Arabia is very positive for the defense and the industrial sector. So let's continue to be positive in the US also, because this exuberance on the euro that we have been talking in the last weeks is likely to start to die down in the next few months. Let's talk about Japan. The data in Japan, the trade balance in particular, has been quite worse than expected. Consider that in an environment in which there's 70 billion of repurchases from the central bank. So this is clearly a sign that on the macro level, the reflation trade, the pro-growth trade has to be calmed down a little bit, because it's definitely not coming as many expected. China is a key factor here. China growth at 6.8, 6.9% is still way below what we should consider if we exclude the effect of debt. Remember that China is adding 4 times more debt to generate 1 unit of GDP than 8 years ago. Within an environment in which the world, the biggest central banks are printing around $200 billion a month without a crisis, we need to be aware of these reductions in macro estimates, when at the same time we have such a large-scale stimulus. Therefore, let's pay attention to earnings. The earnings season has been much better than what we had expected, and that supports equity markets. Let's look at developed markets to go overweight, and let's be quite at least subdued about emerging markets, considering that energy prices, oil prices in particular, are going to continue to be at least under pressure from higher diversification and an OPEC agreement that is obviously not working in the way that they expected in terms of price inflation. Thank you very much.